welcome back to Metals and Momentum. My name's Anthony, and what a week last week. Holy smokes. I still can't believe that we saw such a crazy drop in the metals. Gold down like 10% on the day. Silver down like, I think it was 27%. That's where we ended off on Friday there. But we were down 35% on a single day, and then a slight recovery happened just after that. But my goodness, we are going to go over it here because one of the craziest things that is so wild to think about is not only did we see that 30% drop in the physical metals, but we actually discussed that on the channel here. And I did not see it coming in like a single day. I thought that was absolutely nuts. But my goodness, we're going to go through a bunch of the charts. Now, one of the things that I'll point out to you is I'm Metals and Momentum on Substack. And if you go down through my Substack here, you're going to see my most recent newsletter that actually came out yesterday. And one of the things that we discussed on Substack is that we were moving outside of the physical silver market, and we were going over to this article. If I go to the post, it'll be the first one on here. I'm going to link this down in the description below here. So on the, I think I wrote it actually wrong in the newsletter. So I went to sell my physical silver on the 19th of January, and I was telling Substack subscribers on the Sunday. It was a Monday where I went to sell. Sunday, I was telling Substack subscribers that I booked the appointment. I'm going to sell my physical silver. And at that time, in the US, physical silver was about $92 or $96 somewhere around there. It equated to $129 in Canadian dollars because I'm in Canada here. And I told Substack subscribers the risk to the downside is pretty significant. And one of the things that I was thinking about is if we see a silver crash, then gold is probably going to get hit as well, but gold is going to get hit to a slightly smaller degree. And that's exactly what we saw in the markets on Friday here. So if you go over to the article, this one's called Selling Out of Physical Silver in 2026, right before the biggest crash we've seen in 14 years in the metals. My goodness, what a nuts day. And this is the reason, apparently. So a lot of traders were over leveraged in gold and silver. Silver was just absolutely insane. I'll show you, I have a bunch of charts to walk through here, and I'll go through my weekly watch list. But one of the things that I want to point out here, and this is super crucial, okay? So not only did we predict this because of the topping tail that was formed on the chart here, this is something that we actually went over 2 days before the silver crash on our channel here. I was looking at the topping tail forming on the channel here. We saw this massive breakout, but one of the things that I was also paying attention to is volume. Volume on physical silver was crazy. In this whole last little period, it was like about essentially like the last month on physical silver, volume was just nuts. So one of the things that I will go over is when we hit this peak, volume was just like to the max. Like it was maxed out. It was crazy. Every signal indicator was telling us that silver was completely overbought. The volume was insane. Most of the buyers were piling into physical silver in these final candles right here before this massive drop. So what's absolutely insane is on Friday, you get a drop of 27.8%. That's where we ended the day, from the peak of the top of the day to where we actually closed. That was a 27.8% move, but we had a 14% recovery on the price of physical silver. But we've just slammed through some really, really key levels. And it was wild in that video that I posted just a few days ago. It would be 3 days ago, I guess now, or 3 or 4 days ago now. You just go back on my channel, you'll see it there as the silver warning that I was putting out. And you could see me actually draw this out, but I just didn't anticipate that it was going to happen in one single trading day. I have a price target of $71 silver right now, and I think that on Monday, when the markets actually open, I think that target is going to probably be hit. This red candle doesn't say that there's going to be any kind of slowing down in the selling of physical silver. Now, could we have a slight recovery? I think that's possible, but there's too many levels here now to really go that much farther up. Like, I think that $100 price point, that's going to be a key level of resistance. If we get a rise on Monday, then it will probably just tap out at $100 and then go back a little bit lower here, because the psychological damage done right around here, you're going to have a lot of sellers come to the table if we start to get any kind of a bounce, because they were totally, I can imagine if you majority of people buying in this general area right here are totally underwater, and they're going to be itching to sell as if silver has any kind of recovery. That's why I think this was such a shock to the system that they're going to be looking for. There's going to be people who are willing to be sellers at pretty much any price, and that could take silver down a little bit lower here. Majority of the people recently who were buying physical silver bought near this peak, and we just saw the most massive dump silver has ever seen. And apparently it's due to the election of the new Federal Reserve chairman by Donald Trump. Okay, so this chairman is considered what people were calling an inflation hawk. And I found this article here that really does a good job in just describing it really quickly. So the Federal Reserve is responsible for setting U.S. interest rates. So put simply, lowering interest rates can increase economic growth and employment. So for example, if people are just spending money, then of course that's going to equate to some sort of stimulation within the economy. There's going to be businesses that are doing well because they're receiving the liquidity from people who are essentially getting like stimulus checks. Like, think about it in the most simple terms, just like that. But risk create that, of course, that the whole risk of dishing out money to people is that you get inflation, right? And that's what we've seen over the last many years here, for especially in Canada. Like the last 5 years, inflation has just been really crazy. Like the price of groceries is just absolutely nuts. And that's all that symptom of the money creation that we created during 2020 and into 2021. The stimulus checks, people staying home, not actually going to work, less goods and services are being created, but at the same time, they're spending their money to a higher degree because everybody was just at home. That's essentially the summary of what has happened recently, and that's exactly what it's describing here. So on the opposite end, which we've also seen in the last 5 years, is higher interest rates can control inflation. We've seen an increase in interest rates, especially here in Canada, and the reason why I point out Canada is because when you raise interest rates in Canada, what ends up happening is that you very quickly cool off the economy, because those higher interest rates are almost immediately hitting homeowners, and you're essentially forcing those homeowners to stop spending and pay off their mortgage, because their mortgage will adjust very quickly, right? We've seen that. That's a perfect example of how these interest rates actually affect the economy in the most recent history, like the past 5 years. So it says higher interest rates can control inflation, but at the cost of higher unemployment and lower growth. Perfect example is the Canadian economy right now. Everybody's cutting back. I think I listened to a call where we were talking about some of the the biggest technology companies that sell technology consumer goods. So for example, TVs, like RC cars, cameras, lenses, all that good stuff. All of that is low right now. The appetite for spending on consumer goods, consumer electronics specifically, is very low, especially here in Canada. And that's a perfect example of what's actually happening. You're seeing the interest rates rise and people start to cut back because they're prioritizing paying off that mortgage, which has dramatically increased for some people. We've gone over this in a couple different articles in the past, talking about how, the home market here in Canada is people are getting absolutely squeezed, and now actually even leaving their property, just ditching it altogether. Like, it's just absolutely nuts. So getting back to this article here, so we're describing what is an inflation hawk. So an inflation hawk refers to a central banker who prioritizes fighting inflation compared to a dove who prioritizes growth and jobs. So a dove, Federal Reserve that is more of a dove, is somebody who is willing to lower interest rates and dish out money. Which is what we've seen in the last little while. An inflation hawk is somebody who is a central banker who prioritizes fighting inflation and maybe actually even raising rates. And that is apparently what this new Federal Reserve chairman has established his reputation to be. Now, what we'll have to see and what we'll have to wait to see is if this actually plays out. Like, for example, Donald Trump is essentially electing this person as a Federal Reserve chairman, but for the last little while, he's been saying that interest rates should be at 0%. And I mean, we haven't heard much conversation about stimulus checks, but you could assume once the economy starts to get a little bit weaker, despite interest rates going back down to zero, then I mean, those stimulus checks are probably going to get dished out. Now, whether or not this new Federal Reserve chairman will play ball, that's a different discussion, right? We will have to wait to find out. But that's essentially what has crashed the silver and gold market over the past couple days here, is because this election says to the investors out there that this Federal Reserve chairman is actually going to be a little bit more concerned about inflation. As he sees inflation rise, he's going to start to potentially, his reputation says that he's really more concerned about the value of that US dollar. And that's how we get these big flashes and reversals, because the volume was so high on physical silver that it resulted in a 27% decline, a quick reversal of those trades that traders were actually making. Instead of being very concerned about the dollar, that election of the Federal Reserve chairman, now everybody seems to be a little less concerned. And those trades were all getting reversed on physical silver and gold. So this makes total sense. And here's the gold chart here. As you can see, one of the things that I was pointing out to Substack subscribers is one of the reasons why I was selling physical silver for physical gold is because in any kind of crash, I think gold is going to hold up slightly better than the holders of physical silver. And we've talked about this in recent articles here. One of the reasons why I was converting that physical silver over to gold is because of what exactly has happened right now. So we see a total decline of 27% on physical silver. And then what happened on physical gold? Well, from the peak to where we closed, the drop on physical gold was actually only 10%, which is still unbelievable for a single trading day. But what we've witnessed is physical silver just get absolutely crushed, while physical gold also gets crushed, but to a far less degree. And that comes back to that correlation where physical silver gives you almost like 3x the leverage of physical gold in most periods of history. So when the market is declining, and we're going to go over the S&P 500 chart in a moment, one of the things that we should be way more concerned about is the price of physical silver opposed to the price of physical gold. And that is really something that I tried to warn a lot of physical silver investors about prior to this crash. I was sending videos out. I was actually making even phone calls to people who I knew were heavily invested into physical silver because the chart was just warning this, right? So like I said, what's the next step for physical silver? Well, unfortunately, I think for the rest of this year, we've just broken so many key levels. So I said in previous videos, $100 is a key level on physical silver. Come Monday, like I said, if we get that recovery kind of rally in physical silver, then I think the max upside is probably going to be closer to $100. But this candle is so damaging that we could not actually get the recovery rally on Monday, and we could just continue this decline. We could try and push through this $81 level, and I said in the previous video, the decline from here could get extended all the way down to I would say about $71. I think is going to be another key level, because we have this area of support right here. If you draw a line, let's go do like a horizontal line right here. This would be a somewhat reasonable level where we could expect a little bit of support, and buyers would probably pretty heavily step in at about $71. But if that doesn't hold, then the downside risk here is still another 35%, which is just nuts. And here's the thing with this, okay? So yeah, we'll sit through a 60% decline if you're still holding on to physical silver. But after we touch $54, there are going to be so many people who are going to be incredibly bullish on physical silver, and this right here is a level of key support. Throughout history, we've seen multiple run-ups where you get a 300% increase in the price of physical silver, and each time, twice in the long-term history, if you look at that silver chart, we've seen two major spikes to this $54 level and then bounce back. So now that we've broken way above here, we see the potential in physical silver. This would be the very beginning of like the next major move, and I think we could actually see $200, $250 silver, but this is going to take quite some time. Nobody is going to be willing to step into physical silver if you're a retail investor. The long-term investors who get like physical silver, they understand like devaluations and stuff like that, they're going to be buying at $54. If we get there, $70, I'm sure people are going to be stepping in and buying there. But the retail investor is what causes these massive run-ups in the price of physical silver, and they will be gone. They will be long gone, especially if we get this continued crash. They're going to sell at whatever price, and that is going to take the price of physical silver probably down to $54. $71, that's like an easy call. I think that from here, this is not a significant decline. And we've seen this happen multiple, like a 15% move to the upside was like standard stuff. Like, so now that we are in a downtrend here and like absolutely getting crashed, a 15% crash from here, that's easy. That could definitely happen. So that's one of the things that we talked about in the newsletter here. I've set price targets. If you really want to go back to the newsletter and just rewatch this video here, this was the warning I sent out to silver investors prior to seeing the 27% drop in the price of physical silver. And at those levels, all have been hit, and you can see my thought process in going through that. So I feel like we need to go through the value vein. It's so important to look at the trades that we've made or investments that we've made, and try and understand what have we actually learned from this massive drop in physical silver. Well, the key thing here, the key takeaway would be this topping tail indicator that we saw on the price of physical silver. Now, I went over this in my video up at the top of the newsletter here, describing what a topping tail actually is. But basically, it looks almost like a little sword, really. That's how I like to describe it here. We have this long, long wick, and this was the biggest topping tail I have really ever seen, spanning of 15% to the downside. That's how big this swing was on the silver price during this topping tail here. And these come at the end of a move. And generally, if you do not quickly break above them, then that is a huge warning signal. Whenever I see these topping tails, I start to exit positions or like exit the position, but keep some speculative money there. But in this case, I had exited the position a few days prior to this topping tail actually forming, because I was just saying, this whole rise in physical silver, like I started buying physical silver at $18 and that was Canadian. It was about $12 American. And that's what this whole investment thought was all about, telling you that story of how I started to accumulate physical silver even when I was broke. My first purchase of physical silver, and I actually talked, the guy who I sold the physical silver to, he told me that he specifically remembers when they opened up a kiosk at the mall that I actually bought from for the very first time, and that was he said, I remember this specifically, it's etched in my mind. We opened that kiosk, and the first price that came up on the screen was $18.23, and that's exactly when I bought as well. That was in Canadian dollars. So like I said, probably about $12 on physical silver. And I was thinking to myself, as we get closer to that $100 mark, the risk to the downside becomes pretty dramatic, and that's why I started to exit my position. And then that topping tail confirmed that, oh my goodness, like we definitely need to exit. And that's why I started to send out notifications to Substack subscribers, and also make those phone calls to people and say, hey, if you're invested, like you got to pay attention to this, and you should consider selling some. And I think that was a really good call there. So what else is on the weekly watch list here? This is a part of the newsletter where I just take you through the things that I'm kind of paying attention to. And one of the closest things I'm paying attention to is the S&P 500. The S&P 500 is flashing red on my screen here. This is in a bearish pattern. Throughout the last year, we saw this big rising wedge. It started to get smaller and smaller. The wedge kind of went more and more like this, and was getting tighter and tighter. And now we've seen that breakdown to the downside. We started to form a new channel, which is a bearish signal right here. When any kind of investment starts to trade sideways to upward, but not like to a parabolic kind of degree, and then breaking that previous all-time high, then that is a bearish signal. Now we have broken above this key level here, but we're another psychological level on the S&P 500 is actually 7,000, and we've really yet to close above 7,000, and we've made multiple attempts. So I would even call like this right here, this would be an attempt to break 7,000. This one would be an attempt to break 7,000. We see that break downward out of the channel. And of course, you would always, like whenever the price of an asset breaks out of something, then it wants to retrace and then continue essentially lower. And that's exactly what we're seeing on the S&P 500 right now. So I've laid out the same kind of idea as with physical silver. Where are those key levels to watch on the asset that we're looking at here? The first one is this 6,900 level. If Donald Trump just elected somebody who is an inflation hawk, that's not good for assets. That's actually bearish for a lot of the American market, and especially if the American market is priced at all-time highs and all-time high valuations as well. And that's exactly where we're at in the S&P 500. And we've broken back down out of this channel. That is a bearish signal. And I'm looking for over the next, like, call it maybe like 2 months or something like that. I'm looking for a downside of, oh, actually, I'm not measuring this out here. Let me grab the measurement tool. I'm looking for a downside of 5%, but I'm also looking for the S&P 500 to come back and tap that 200-day moving average. Now, this 200-day moving average will rise over time, so the longer it takes to get there, the higher this will be. So that's why I think this third support is a good area. But if we break that third support, that will also break the 200-day moving average as that climbs up here. And the next level downside target I would have is 6,100 on the S&P 500. That'll be an 11% decline. I think that's very, very likely, especially now that we have the confirmed news that Donald Trump has elected this new Federal Reserve chairman, and he might not actually play along with Donald Trump's demands in lowering interest rates down to zero. And later on, as we start to see this decline, I bet you that Donald Trump will start to demand stimulus checks. We're already talking about it with the tariff checks as well. This revenue that's coming from the tariffs, Donald Trump wants to dish that out to the American consumer, and that will stimulate growth as well. With the moment we have something like that, then it would be game on for a lot of assets, because a lot of that money is not going to flow into businesses that are not on the stock exchange. I think it's going to flow into things like the S&P 500. So the decline here of 11%, this is very concerning. I told Substack subscribers I'm super defensive. In fact, I said throughout 2026, we're probably going to swing trade majority of the year. I've removed all of my long-term hold positions for now, and I'm advising my Substack subscribers to essentially do that as well. Raise cash levels, store your cash in something that will actually pay you a little bit of a dividend, but won't experience the downside. And we've gone over that strategy on the pay tier of metals and momentum as well. I think gold's a good place to be, but like I said, I mean, 10% in a single day, that's just, it's like almost unheard of in physical gold. And the downside, kind of worst case scenario on physical gold, would be a 14% decline. I think that's probably pretty likely, actually. But if we start to get a really big move in the S&P 500 downward, then the price of physical gold could try and retest this 43.50 kind of level here. That is going to be a key level of support. Worst case scenario on physical gold, I think we could probably retest that 200-day moving average. It'll be about a 20% decline, 25% decline as this kind of moves, this 200-day moving average starts to climb upward. It'll probably meet somewhere around here, but like I said, the longer it takes to get to that 200-day moving average, the higher that 200-day moving average is actually going to be. So the decline could be somewhere around 23% around here, and that would also match some of the support that is also laid out on the chart here as well. So there's some key levels around here, and that would not be abnormal for the price of gold, right? Like we've seen multiple times in history where there was a huge gold bull market happening, but we've also had to sit through 40% declines in physical gold as well. I wouldn't be too concerned about physical gold. Silver, like I said, was the one where you definitely have to be concerned about, because you don't want to sit through a 60% decline and then have to wait. Who knows? Like it could be another year. It could be 5 years for the price of physical silver to actually decline, to rise back up and meet those previous peaks. So I said to Substack subscribers, we want to step aside and let this play out. Now, I'm not super concerned about physical gold, because 20% decline in an asset, it's not crazy. And especially if it's only, say, something like 25-30% of your portfolio, that's pretty high for a lot of people. A lot of people don't have any exposure to physical gold. But as we start to decline here, it's not like you're going to be super stressed about it if we see a 20% decline. I think that's like status quo for any kind of metal here. So that's something I'm definitely paying attention to, and that's the key levels on physical gold. Now, in January, we started to swing trade the oil stocks. And this is something that's part of the paid tier of Metals and Momentum. It's $9 Canadian per month if you want to get trade notifications from me and get access to this longer term portfolio. Now, a lot of the positions I've removed right now, so we're sitting tight on that. But I'll still throw up indicators, watching the trends, and still give you some indicators as to what to potentially think about doing with your long-term portfolio, because I know a lot of people are more long-term investors. So I still give that guidance. But one of the things that we absolutely crushed it with in January was this swing trade in the price of oil. Now, I'll show you a warning signal on oil here in a moment. But going back to late December, we started to get very bullish on the price of WTI crude oil, right? So we started to make purchases of the oil stocks right around here. We actually caught this up move up to the 200-day moving average and removed the positions. And I was waiting for this breakout. So we actually started to get the breakout. The problem with this, though, and I'll just remove this here. And I'm going to go to a measurement tool. The problem with this breakout is we saw a huge move really in this candle right here. This candle ran up 5.4% on the price of WTI, but the market started to get sucked lower, meaning that the S&P 500 started to actually decline right around here. So we see this big, or not really big, but like a little bit of a decline in the S&P 500. We saw the volatility in silver and gold and things like that. But the oil stocks really didn't do much. Like, for example, one of the stocks I was paying attention to was Exxon. Exxon should have ran much more than what it did. Like, if the price of oil is going up by 5%, Exxon should have ran probably closer to like 7%, 8% around there. Like, you'd think, right? Like, this is some of the biggest oil producers in the world. If the price of gold jumps 5-6%, then the gold miners probably run like 12. Now they're a little bit smaller than the oil stocks here, so you would expect a little bit less volatility in the price of oil stocks. And even like something like IMO actually declined on the when WTI started to actually increase. So we see this run up of 2%, but then to the low here, we actually dropped 4%. So all of this was caution, and CNQ is one of the ones that we started to trade. One of the things that we did was, once this broke out, we sent a trade notification out, and we were able to just capture, it was like a I think it was 5% or 8% gain on this. But once I saw that decoupling of the oil stocks compared to the price of WTI, then I started to get very concerned and quickly sold off the position. And that's one of the things that we did this week here. And I think we've actually tapped this key level of resistance. I put a price target of WTI at $66. And since we've essentially run up there really, really quickly, I think there's going to be some consolidation here. Maybe we could go a little bit higher on WTI. Honestly, I'm not really super confident, especially if all of the commodities start to decline. I think the price of oil, although it's very, very low right now, I think it's probably going to get sucked into that decline as well. Last one I want to go over here. This is in the newsletter. This is part of the paid tier. We go over this on the paid tier section. Some of the new things that I'm looking at is this Van Eck Agro Business ETF. This is MOO. This is a stock that's kind of interesting. It was meeting some of my indicators that tell me that, we should maybe consider putting this into a long-term hold. And I'm looking at this, and the chart has just gotten really extended here. I think what's likely going to happen, especially as the S&P 500 starts to decline, if that happens, we're going to start to see a decline and a pushback down to this $75.99, $76 kind of range. And we're going to watch these key 5 indicators that I actually pay attention to for long-term holds. And I'm going to reassess this ETF as we get a little bit lower here, because I think this is a good opportunity. There's some decent upside in here, and we're going to talk about that on the paid tier of Metals and Momentum. We just mentioned it in this week's newsletter, and I think this is an interesting opportunity right here. So it's on the watch list right now, but once we start to get lower on that ETF, I'm going to reassess those 5 key indicators that I pay attention to, and maybe we're going to add a position into MOO. So we'll see. We'll wait for trade notifications on that one. If you want to get trade notifications from me, go to Metals and Momentum. The links are down in the description below. Like I said, it's $9 Canadian per month. So for Americans, like if you're trading in American dollars, you could pay in American dollars, and that would be something like I think it's probably like $4 or something like that right now. The exchange rate is pretty brutal. So if you want to get trade notifications, hit the links down in the description below. That is where I'm going to leave it. It's such a wild time in markets right now, and you got to be looking more at what is the downside opposed to what is the upside on a lot of assets right now. I think we're getting into a super volatile period. And that S&P 500 chart, that is the most key chart we're watching right now. And as that starts to decline, a lot of the other stocks are going to get sucked into that decline. And when momentum and the tide is actually shifting outward, you don't want to go and test into those waters, taking on wild trades or anything like that, because as we just went over with the oil chart, that was a good setup. The price of oil actually got to our key target, but the price of the oil stocks got sucked down with the S&P 500, and that's what could happen when broad markets start to decline. So wait for those trade notifications from me. If you're part of the paid tier, watch out for those, but if you're not, consider joining Metals and Momentum. Like I said, all the links are in the description there. That's where I'm going to leave it. Thanks so much for watching, and we'll see you in the next one.